Two of the most well-established and really classic candlestick patterns are the hammer and hanging man candlestick patterns. So let's look at those and how to recognize those. And these you'll see fairly frequently, and you can kind of watch for them. People really love to trade candlesticks. We really watch for hammer and hanging man a lot of the time, and that's how they trade. So in a hammer, you have an established downtrend. You can see here how we have those four red candlestick bars. So that's showing our closes are lower than our opens each day, and we got lower lows kind of going each day. And then a hammer is going to mark the end of the downtrend. And what you'll see is where you're going to get a green type bar, and you're going to have a long wick on the bottom. That's what you're looking for, is a long wick on the bottom, and not much wick necessarily on the top, but you're looking for that long wick on the bottom. And what's happening is, sellers are able to create some new lows. That's why you have the long range to the long low there on the bottom. But last minute buying overcame it and actually created a higher close. So it started off as far as the opening being lower again, like the trend was continuing. And then they tried to drive, the sellers were trying to sell even more, and it was real bearish, and things were trying to go even further down in price and really continue a strong, let's say, downward trend. But now prices have really kind of reached their exhaustion level on the lows. And buyers are saying, no, this is maybe a good opportunity to buy. And so they push up from that whole range of lows, a real long range, and push it up and actually create that the close is going to be higher than the opening, and thus changing the color of the bar. And then you'll see it kind of being confirmed over the next days. You need to let the trend form and all that, but this is a good recognition that something's going to happen. And you can see over the next couple of trading periods that now we get more into an upward trend where we have higher highs is what we're seeing there. So you're looking for that downward hammer, you're looking for that downward trend, these low lows, and then kind of a reversal from there as now buyers get back in and say, no, we got to move this up. This is way too low as far as the price. Now, a hanging man is essentially the opposite. You have an established uptrend where things have been trending upwards. Each close or each open is higher than the close from the day before. We have green candlesticks in this case, but that's hanging man marks the end of an uptrend. And if you own the security, that's the time to sell as far as at a profit. On a hammer, you're looking to get in and start riding a new trend going upwards. But if you own a security and you see a hanging man, now it's time to let's watch, because this might be the time to sell. And what's happening is bulls, or people who have faith in the security, they're unable to keep the bears from making a new low and from keeping the close below the open. They want to continue that uptrend. They want to see that uptrend happens. But what's happening is the uptrend doesn't continue. You have, again, this very low lows. Again, it looks like the hammer where you have a shaven top, but then have a long wick and lower shadow on the bottom. But you can see how it's how the candles change from green to red, that the close is lower than the opening. And so now we're anticipating a reversal, and you'll see that play out in a true hanging man pattern, where now the candlesticks afterwards continue. Maybe they could go a little sideways, but you're probably hopefully looking, or you might see more of a downtrend there, and anticipate that. So hammer and hanging man, the actual candle itself has a shaven top and a long wick at the bottom, but you want to see where they're at in the pattern. That's the key part. You can't just look at it itself and say, this is what it is. You need that pattern coming before to kind of confirm that it's, that it's establishing this true hammer or hanging man chart pattern, and then you can trade that indicator accordingly. Let's talk harami and engulfing candlestick patterns. They're similar, but yet slightly different too, of course, as well. And let's start with the harami. And harami actually means pregnant in Japanese. And you can, if you look over in that samples I have there on the left there, you can kind of see where you have a small real body comes after a bigger body before it. Here we have a long red candle, and then we have a short real body in terms after it. So you can almost imagine it's like somebody might be pregnant or whatever. And that's the idea behind a harami, is that you have the small body coming after a big bodied candle. And you want to look at the color of the candle makeup. It's green followed by red would be a bearish type sign, and red followed by green would be more of a bullish sign. So in our example here, you can see that we have a red candle, and then that is followed by a green one. So this would be a bullish one. And you can kind of guess at that because you can see there's going to be an upward trend following afterward. And what harami is really telling you is it's an indication that a change in sentiment is coming. Something's coming. So if you're looking for an indicator that say, hey, there might be a reversal or some change coming here, harami is going to be very helpful for that. And the smaller the real body on the second harami, the more powerful indication that the reversal is coming. If it's not much difference between the two, then it's not really a harami. You're looking for a taller or longer real body candle followed by a shorter kind of squat, small distance one followed by after it. And you're looking at the real bodies of these candles a little more so than, let's say, the wicks going up or down. But that's where you're looking at these open and closes around the candle. So if you're looking at this harami, you'd say, okay, we can see we've been in a definite downward trend, or we've got a couple, basically 3 red candlesticks in a row. Boom, all of a sudden this narrow trading range, but the opening is low and the close is higher, so it changes the candle color to green. That was now a higher open, or excuse me, a higher close than the open after we've been in a downward trend, signaling that a trend change might be coming. Now, as we know with trends, we want to make sure we let the trend develop. We could see this and say, it's definitely harami, and it turns out to be a false signal. It's not harami at all. So once we see that second day and certainly that third day, now we're starting to see more of a confirmation that a real trend reversal has occurred, and that now we can be trading off of that. How soon you get in, you might be a little bit more related to your risk and and how you want to judge that, and be whether you want to be quick on harami or whether you want to let that form more and be a little bit more confident. Either way, you're looking at a real body, a bigger one followed by a small one. Just look at the which one's preceding which to see whether that's a bearish signal or a bullish signal. Like the Harami, engulfing candlesticks also will signal a reversal of a trend. So you're looking at trends and you're seeing if it's going to continue or be changed or reversed. And that's where engulfing candlesticks work just like Haramis. But it's the kind of, if you look at the images on the left here, you can see what's highlighted in the square. It's kind of the opposite, right? You don't have that pregnant type look. You have the opposite where you have something that's shorter and smaller being engulfed by something that's bigger. And that's the key thing. You have to wait for that second bar, in the example in the box here, to occur. You can't just guess, oh, well, we have, let's say, an upward trend, and all of a sudden we got a shorter real body and say, oh, we're definitely going to have a reversal. That could not be true at all. It could be just a little it's just a matter of a trading day. And in terms of open and closes and the trends, it's going to continue. They usually don't look this clean and neat. You're looking for something that's going to engulf it. And that's really what's happening is there's a wider range of the opening and closing than the day before. And if you can look at either of the examples, you can see that the second day in the box is bigger or wider or basically taller, and it's going to completely engulf. And that's the key thing. It's going to completely cover or engulf the opening and closing of the day before. And if you have a higher opening and a lower close in this engulfing candlestick, that's a bearish sign. Prices are going to start headed down. And if you have a lower open but a higher close, then that's a bullish signal, and then prices will start rising. And in both ways, you're looking at the previous, what's happening before, to see if there's an established trend, because this is all about trend reversals. It really works when there's a trend, not so much when there's no trend yet at all. So if we look at that example up at the top with the bearish engulfing, we've got a nice strong trend. We've got higher highs going on there. Even that small little short one there of that candlestick is still a little bit higher than the high day before as far as the close. And so everything's going green, everything's going up. And then all of a sudden what happens, you have this big engulfing candlestick. So you see that engulfs it. You have this big red thing where the opening is opening higher than the day before, but then the close is going to go lower than the close the day before, and that's why it's a red candlestick. And so that's telling there's a lot of downward selling pressure. And that's why you need to wait for the next one to just confirm it. This will look like it, and some people, you can trade right on that and say, oh, that looks real bearish to me, I'm just going to do it. And that's okay. You're taking more risk that way, and you have a better chance for being wrong or a false signal, but you can certainly do that as far as your own risk and reward pattern around that. But if I look at, let's say, now the second red candlestick that's coming outside the box on this bearish engulfing, I can see, okay, now I'm seeing lower lows, and so now I think we've got a true bearish engulfing pattern here, and then if I own the security, I would sell it. I would sell at some point here to get out, because I've already made my profits on that nice trend going up, and now I want to take my profits. Now, if I look at the bullish engulfing, maybe this is a security we're not in because it's going down in price. We have a definite downward trend with all those red candles down there. And then we have the similar thing, just the opposite. We have a lower low, a short body in the red, and that's then engulfed by this nice big green candlestick, the real body of the candlestick. And so we have our closing it's higher than the open and close of the red candlestick. And, everything's being engulfed in there. We wait for the next candlestick outside the box to kind of give us some confirming, waiting for that second bar to happen, and price bar. And we can see, yeah, this is a trend reversal. Look, we're going upwards now. So when you start seeing things like engulfing candlesticks, think, is a trend being reversed? Is there a trend, and is the trend being reversed? And wait for it to happen. The longer you wait for it, you're going to lose a little bit of opportunity cost where maybe you could have gotten a little earlier, but you're going to have less losses as far as being wrong or a false signal. It's really good to let these engulfing candlesticks kind of truly, form a little bit and have that second bar, the one outside the box. So basically, and to kind of both bars basically. The engulfing one and the one after can be really good confirming patterns with engulfing candlesticks, and they work just like Haramis, where you're looking at trend reversals. So shooting star and window candlestick patterns are very interesting patterns themselves here. And a shooting star, we'll start with that one. You have a small real body and a long upper shadow, right? And what it's doing is it's implying the failure of a trend to continue. It's a failure to close near the high. Certainly the high being that whole upward shadow, that whole long upward line on the trading range going up. It's not getting you near how high it got during the trading period, the trading day, for example. It's coming back down. So you can see in the example here, we have a green candlestick, and if there were, let's say, there are other ones out there before that, so we're on a trend upward. I threw in a doji just for fun. Sometimes you'll see shooting stars after dojis. Again, a doji shows that there's indecisiveness. So maybe there's been a trend. We haven't had a real, let's say, reverse or anything, but we have a doji saying, yeah, they might be getting a little indecisive. It could either keep going up or keep going down. We got to go sideways. We got to watch, and then boom, all of a sudden we see this shooting star. And we see that, basically, that there's a high established as far as at the opening, but the close is closing lower. That's why it's a red candlestick, because the close is lower than the high, or the close is lower than the opening of the day. But in that candlestick, that first red candle, you can see has that real high kind of shooting star, kind of like the shooting star as far as the range of prices. So there was a lot of higher prices going up there. There was people trading at much higher prices, but it all started to come down, towards that real body there on the shooting star. And then you want to see what happens next. It's a good indicator that you've got a failure of the trend, and then we're going to go sideways or start a reversal of the trend and start going downwards. So if you shoot a shooting star, be aware that if you've been owning a security, that might be a time to get out or be wary of that and be ready to kind of pull the trigger and take your profits. A falling star would be the exact opposite pattern, by the way, if you were looking at, let's say, like a falling star, and that would be more of a bullish signal, where this is a shooting star is more of a bearish signal. A different type of signal, and this kind of works with our gaps, if you looked at the lessons around gaps, is rising and falling windows, right? And so really what you're seeing is it's kind of like a gap up. It could be a breakaway gap, it could be a runaway gap, but for a rising window, you have basically a gap up. And what happens is the third day in the pattern does not go down to fill the gap. sometimes people trade and they're like, oh, I anticipate it's going to go down because we have this gap and it's not really a lot of volume behind it, not a true, let's say, breakaway gap. So that third day, it's going to come back down as far as what we'd be watching for. And if it doesn't come back down, then we have a true breakaway gap. And this would be in a case of what you could call a rising window pattern, where the gap isn't filled and the upward trend continues. So you're kind of looking for this pattern in this example where you have a rising window where you have a gap, and then you have that continuation of the trend. It doesn't go back and fill that gap. It kind of fulfills that whole definition of a gap that we learned about in other lessons too. The same thing with a falling window. You're really looking at a gap down, right? We're looking at our bars from left to right. We can see we've had some downward trend. That's the red candlesticks in a falling window versus the green candlesticks in a rising window. So we have this candlestick. Now we have a gap, and they're both red, so we're both going downwards. Our prices are falling. And then the third day, and the pattern does not go up to fill the gap, right? It doesn't go up and do that to basically fill the gap and try to maintain that more overlap. It's going to keep going down. And so that's more of a falling window and really kind of a confirmation that the gap is a true gap and that the trend is being a really established trend is happening, and that trend is going to continue. Again, breakaway gaps are going to look at creating new trends, or this could also have been a runaway gap, which is a continuation of a previous trend that we're not seeing on the images here. So look at the gap lessons again to see to reinforce stuff about gaps. But basically what's happening in rising and falling windows is the trend is going to continue after the gap and really be established versus coming back downwards and filling that gap. And that's what you want to watch for. Let's look at 3 soldier and the counterpart of 3 crow, and basically a 3 green or soldier one would be 3 green or white depending on your charting software. But basically you've got an upward trend. You've got 3 long green bars. That's the key thing you're looking for. You've got 3 long green bars, and they're all consistently all in a row, kind of lined up like little soldiers, right? They're lined up like if you have play soldiers or something, and they're all lined up in a row. And it's really showing the continuation of an uptrend. And really what you're looking for is that they're longer green bars and that the consistency part, they're very orderly. It looks like they're marching in formation, so to speak, or at least marching upwards in formation. And that's a continuation of the uptrend. That's the indicator that you're looking at. And the stronger that indicator would be is if the top wick, the top part, upper shadow is short. And so it's showing that the close is at or near a high. We don't have real long wicks showing that we really went up real high, but then it came way back down. This is just a nice orderly, it's just following like little soldiers going right in a pattern, going forward. And really the key thing you're looking at in a soldier pattern is that it's consistent. Both these patterns, you're looking for these kind of consistent looking bars, not a lot up and down, just real orderly. And so that shows a strong indicator the trend is going to continue and go in that same direction. Now it could be going the opposite direction, a downward direction, and then we'd be looking at 3 crows. And those candlesticks would be red, or again, depending on your trading platform, could be black. Either way, it's going to be the opposite of something that's trending up. We're looking at 3 red bars. And they're going to be the same thing. You're looking at longer red bars. You're not looking at dojis or very small real bodies. You're looking at, really good kind of consistent long red bars. Again, all consistently in a row, less like the soldier pattern. They're called crows because they're going downward. So decided maybe to be a crow. And it's a continuation of the downtrend. You're looking at it and say, yep, prices are going to keep going down. I see these 3 red crows. They're marching in a nice, orderly fashion. I'm going to, then trade accordingly around that. And so the stronger the indicator would be if the bottom wick is short, so that's showing where the closes are at or already near the low. They're not going way, way down. And certainly there's no real long upper wick trying to drive highs. They're real consistent red bars going in the same direction. In this case, for a crow, they'd be red and prices would be following, but you wouldn't have a long wick at the bottom. So the shorter the wick, the better the indicator. And again, looking for both these patterns, what you're really looking for is that there's consistency. And it's really, that's why the number 3 is important there, because 2 can give you an idea or something like that, but you start getting 3 and they're all consistent like that, then that's a real, really proven kind of pattern out there. Nothing's perfect, of course, but a real proven pattern showing that we're moving in a direction either with the soldiers going upwards in a trend, and that's going to continue, or with the crows going downward in a trend. So look for these chart patterns. Well, I hope you enjoyed this powerful section on candlesticks and candlestick patterns. And I'll leave you with some final thoughts. And one thing too, as you start to see patterns, you start to see more and more candlesticks, they'll become more second nature to you. So if it seems like that's like a little bit harder to grasp, you can always go back and watch a lesson. And again, as you actually start using it, whether it's with paper trading for practice or when you're real live trading, you're going to start seeing these things very, very easily, and it's going to help you become a very successful trader. So some final thoughts around this is, one, you want to continue to learn and practice and learn to visually recognize what these candlesticks are trying to tell you. They're trying to tell you something. So the more you understand the candlesticks, and you can, and their patterns that go with it, especially the Kahneman patterns, and you can just visually look at it and see, oh, that jumps out at me. I know this is what's going on. That's going to be very helpful, and that will come as you learn and over time. And also that there are many candlestick patterns out there. I've shared the most common, most classic ones that almost everybody can use and maybe should use, but there are a lot of different patterns out there. If you search the internet, you might find all sorts of patterns. In fact, if anything, there's too many patterns, and they can be detrimental because some are not as statistically valid as others. Ones I've shared with you are ones that are the best ones. So if you try to learn too many patterns, you can have this steep learning curve because you're trying to keep all these patterns in your head, and that can actually cause you to be impact your trading in a negative way. Other things is, you start to see all these patterns, you might start seeing things. You try to learn too many patterns at first, and you might have mirages where like, oh, I think I see this, but really it's not there. right? It's a mirage. And you start getting where you look at your charts and everything starts swimming around like, oh my gosh, everything seems like a pattern or nothing seems like a pattern. So start by focusing on, patterns that seem most interesting to you, or certainly the ones that I've shared with you. Start there, and then you can build from there if you want. But too much can be sometimes not helpful either as far as candlestick patterns. And as I mentioned in a couple of the lessons, I said that some people only trade candlestick patterns. They just really focus on that, and that's okay. They can be successful that way. I would say take some of these other lessons that you're going to learn and think about that. If you love that idea of candlestick and trading just these candlestick patterns. And by the way, sometimes a lot of these patterns are not as common, so your trading might be not as frequent too. If you're looking for just a certain doji setup or a certain pattern setup, it might not be as common as other types of patterns out there. But a good practice too is as you learn other things in the course is to combine it with other indicators for like confirmation. So maybe I see a candlestick pattern forming. I might confirm it that, okay, volume is doing what I'm expecting to, either rising or falling or staying the same. So the trading volume is there confirming, but I might want to confirm it with other things I'm learning, like trend lines, moving average, weighted moving average, simple moving average, trend lines, general trend patterns, upward trends, lower trends, these moving averages, momentum indicators, sentiment indicators. There's things we're going to learn throughout the course here that you can use, that if you see a pattern from a candlestick aspect, you can go outside that to something a little bit different and say, okay, I see this happening. I'm going to use a momentum indicator and see if that actually confirms what I'm seeing here. That both my candlestick pattern and my momentum indicator are saying prices are likely to rise. Well, then I'm going to buy because I'm getting a double confirmation. And we'll learn all about that too towards the end of the course, where we talk about kind of setting up your strategies and stuff too. But right now we're learning the tools and how to apply these tools and how to apply them to be, so you can be very successful. And I tell you, candlestick patterns, great section here, and really get into that, and that can really make a difference in your trading and help you to be very successful. So let's learn about some more indicators and ways to interpret using technical analysis.